We'll now talk about Section 3, Long-Term Framework for Exchange Rates. And essentially in this section we focus on international parity relations or international parity conditions which help us determine long-term currency rates. Before we get into the specific parity conditions, let's cover a few basic concepts. The first one to talk about is long run versus short run. So as indicated here, international parity conditions help us determine long-term currency exchange rates. So what about the short run? And Exhibit 2 in the curriculum gives us a nice little illustration where the exhibit gives us real exchange rates on the y-axis, time on the x-axis. Now you might have a situation where for a given currency pair the exchange rate is trending upwards. So this is the long-term trend, and we can have a sense for this trend based on the parity conditions that we will talk about on subsequent slides. But exchange rates do not follow this nice trend. There are short-term fluctuations in the exchange rate. So the simple way of looking at it is that while parity conditions help us determine exchange rates in the long run, in the short run there are several other factors which will cause exchange rates to deviate from the long run expected value. So that's the first basic concept. In section 3 we focus on the long run, and then in subsequent sections we look at variables that impact exchange rates in the short run and the medium run. Next point is real versus nominal rates. You have seen a lot of this in level 1. The observable rates for, say, interest rates or for currency exchange rates are nominal values. So if we say that the interest rate in Pakistan is 12%, this is a nominal value. Real values adjust for inflation. So if inflation in Pakistan is equal to 10%, this would mean that the real exchange rate is adjusted for inflation. So real exchange rate is approximately 2%. Similarly, if we say that the rupee dollar exchange rate is 94 rupees to the dollar, this is a nominal exchange rate. When we adjust these numbers for buying power or for prices, then we get real exchange rates. Expected versus unexpected changes. Here again, you can look at a variable like inflation or price levels. You can have a situation where you expect price levels to go up by, let's say, 10%. So this would be an expected change. If prices do go up by 10%, then that's what's expected. But prices will not necessarily go up by 10%. If prices actually go up by 12%, then the 2%, the difference between 12 and 10, reflects unexpected changes. And very loosely speaking, it's when we deviate from what's expected, that's what creates risk. So in other words, risk is deviation from what we expect. And finally, relative movements. When we talk about currency exchange rates, and let's say that one determinant of currency exchange rate is inflation, or the inflation in the two countries. So again, continuing with Pakistan and the US, the point here is that if exchange rate is being influenced by inflation, what really matters is the difference in the inflation of the two countries. So simply knowing that inflation in Pakistan is 10%, this does not help us determine what will happen with the rupee dollar exchange rate. But if we also know that inflation in the US is equal to, say, 3%, then it is the relative movement of price levels or the difference between these numbers that helps us determine what will happen to exchange rates. So the key point here is that relative movements are what matter much more. And finally, a core point is that there is no simple model or formula that will allow us to precisely forecast exchange rates. What we are simply studying is tools or elements that help us forecast, but none of these are perfect. So now let's get into the actual international parity conditions, and these are the 7 elements that we will study. Let's start briefly with covered interest rate parity. So as we have seen before in section 2, the covered interest rate parity relationship essentially allows us to determine the forward rate. So as a quick recap, the forward rate is equal to the spot rate into 1 plus interest rate in the price currency divided by 1 plus interest rate in the base currency, and then we obviously adjust for days divided by 365 and or 360 depending on the convention, and the same thing in the denominator. So we've already studied this, won't spend too much time on this again. So remember, covered interest rate parity helps us determine the forward rate. Next, uncovered interest rate parity. So this relationship essentially says that the change in spot rate over the investment horizon should, on average, equal the differential in interest rates between the two countries. Now, a few key points here. When we talk about uncovered interest rate parity, what we are really now focused on is expected spot rate. So to give you a simple example and to distinguish between expected spot rates and forward rates, a forward rate is a contractually agreed upon rate. So you might say that the forward rate for rupee dollar is rupees 100 per $1. So this would be, let's say, a 1-year forward rate. Now, another question is, what do you expect the spot rate to be 1 year from today? And according to the uncovered interest rate parity relationship, the expected spot rate is also going to be equal to 100. So if uncovered interest rate parity holds, then the expected spot rate 1 year from today is the same as the 1 year forward rate. Now, moving on, I'll repeat this statement because this is key. According to uncovered interest rate parity, change in spot rate over the investment horizon should on average equal the differential in interest rates between the two countries. So how can we express this in a formula? So we can say that the percentage change in spot rate is equal to the difference between two interest rates. So if we use the example in the curriculum, we have the curriculum uses in this context a foreign currency and a domestic currency. So let me take a simple example here. So I'll just first write this down. The expected percentage change in spot rate is equal to the differential between the interest rate in the foreign currency and the interest rate in the domestic currency. A simple example, let's say that we are talking now about euro dollar. So say you are a US investor and you are investing in the eurozone. So for you, the foreign currency is the euro and the domestic currency is the dollar. Let's also say that currently the exchange rate, which is euro to dollar, so how many euros per unit of dollar? For simplicity, let's say that this is 1.0000. So this is our initial exchange rate. Let's also say that the interest rate in the foreign currency, which is the euro, is equal to 5%, and the interest rate on the domestic currency, which is the dollar, is equal to 2%. According to uncovered interest rate parity, the expected change in spot rate over 1 year, because we are using annualized numbers over here, the expected change will be 5% minus 3% minus 2%, which is equal to 3%. So uncovered interest rate parity predicts that over a 1 year period, the base currency, which in this case is the dollar, will appreciate or strengthen by 3%, and that 3% simply reflects the differential between the interest rate on the euro, which is the foreign currency, and the interest rate on the dollar, which is the domestic currency. And if you recall, this is consistent with what we saw earlier with covered interest rate parity, where we said that the currency with the higher interest rate will lose value, and the currency with the lower interest rate strengthens. So another way of looking at this is that the expected appreciation or depreciation of exchange rate is basically offsets yield differentials. So continuing with this simple euro dollar example, we have a situation where what we are expecting, given the difference in interest rates and given uncovered interest rate parity, we are expecting the dollar to strengthen. And we are expecting the dollar to strengthen by 3%. So another way of looking at it is that this expected appreciation of the dollar basically will offset the yield differential of the dollar and the euro. So in other words, if somebody makes a euro-based investment, he will, so for the US investor that I was talking about earlier, if he invests in Eurozone, then in terms of euro, he will make a 5% return. But since the euro will weaken, or we can say the dollar will strengthen, in dollar terms, his return is going to be less. So in dollar terms, it will essentially boil down to 2%. So effectively what we are saying is that the expected appreciation offsets yield differential. A high-level remark about uncovered interest rate parity is that it holds in the long term, or actually studies have shown that generally speaking, uncovered interest rate parity holds in the long term, but it does not necessarily hold in the short term and medium term. Another relationship that I want to share over here, that's not given explicitly in the curriculum, but you will need it when you solve problems later, is that you can write the uncovered interest rate parity relationship like this. The expected spot rate is equal to the current spot rate into 1 plus interest rate in the price currency divided by 1 plus interest rate in the base currency. And I'm skipping it because it's obvious, but you still need the days over 360 and days over 360 over here. So note that this is very similar to the covered interest rate parity relationship. The only difference is that covered interest rate parity gives us a forward rate, and uncovered interest rate parity is used to estimate the expected future spot rate. A few more basic points and then we will get into example 4. According to uncovered interest rate parity, the current forward exchange rate is an unbiased predictor of future spot rates. So as you just saw, the formulas for the forward rate and the expected spot rate are essentially the same. And since they are the same, we can conclude that according to uncovered interest rate parity, the forward exchange rate is an unbiased predictor of future spot rates. So just memorize the statement. The curriculum makes another useful statement which helps you understand this concept. So asking whether the forward exchange rate is an unbiased predictor of spot exchange rates is essentially the same as asking whether uncovered interest rate parity holds. So this is another useful statement to remember. Now, looking at the distinction between covered interest rate parity and uncovered interest rate parity. As we've seen before, covered interest rate parity is enforced by arbitrage. So this allows us to determine the forward rate. If this relationship does not hold, then there is a lot of arbitrage profit that can be made and the forward rate will adjust. So essentially, arbitrage helps enforce that covered interest rate parity holds. Another point to keep in mind is that for uncovered interest rate parity to hold, speculators would have to be risk neutral, and hence speculators are not risk neutral typically. Therefore, as we discussed on the previous slide, uncovered interest rate parity generally does not hold in the short run or even the medium run. And finally, the concept of hedging currency risk. If you are a US investor and you invest in, say, the Eurozone, to hedge your currency risk, you need to have a forward contract. So with a forward contract, you lock in the exchange rate. So if you are making a 1-year investment sitting in the US, you are investing in a euro-based investment. To remove currency risk, you will essentially make the investment and also get into a forward contract which locks in the euro dollar rate that you will get at the end of your investment horizon. So that's how you hedge your currency risk. Another way of putting it is that if you have a hedged foreign exchange exposure, that if you've hedged your foreign exchange exposure, that means you've taken that means you have a forward contract. Unhedged position means that you do not have a forward contract. So to really understand the concepts, or to essentially cover yourself from an exam perspective and to hedge your risks, you need to cover example 4 very well. So let's do that. You need to have example 4 open in front of you right now. Here is the basic data. We are given the Japanese yen to Australian dollar exchange rate, or the current spot rate, and for simplicity we are just being given the mid-market values. So fortunately we don't have to deal with bid-ask spreads over here. We are given the 1-year forward points data, which is minus 301.9. One small point to note over here: when you have a currency such as Japanese yen to Australian dollar or Japanese yen to US dollar, note that we only have 2 numbers after the decimal place. So this means that when we convert forward points into a decimal, we simply divide by 100. So 2 decimal places over here, that's why we divide by 100. Recall that with euro dollar, we had 4 decimal places and therefore we divided by 10,000. So the all-in rate would essentially be this number and minus 3.019. So that's just a side point in case you are confused about forward points. We are also given the exchange rate on a 1-year Australian deposit and on a 1-year Japanese deposit. And the first question now is, based on uncovered interest rate parity over the next year, the expected exchange rate change in Japanese yen to Australian dollar is closest to what? So for question number 1, recall that the basic formula for uncovered exchange rate parity is the following. The percentage change in spot rate was equal to the interest rate in the foreign currency minus the interest rate in the domestic currency. In this particular case, we have 5% minus 1%, which is equal to 4%. Question number 2 says, the best explanation of why this prediction may not be very accurate is that. So again, this emphasizes the point that the prediction that is made based on uncovered interest rate parity is not necessarily accurate. So it doesn't necessarily hold in the short run or the medium run. So the options are covered interest rate parity does hold in this case. So that is so the point is covered interest rate parity holds, but that does not necessarily mean that uncovered interest rate parity will hold. So that's not the correct answer. The second option is the forward points indicate that a riskless arbitrage opportunity exists. That again is not the correct answer. Option C is there is no arbitrage condition that forces uncovered interest rate parity to hold. And this is the correct answer. So we've already discussed this earlier, and this is a point that you need to understand well. Then question 3, using forward points to forecast future Japanese yen to Australian dollar spot rate 1 year ahead assumes that A, investors are risk neutral, B, spot rates follow a random walk, and C, it is not necessary for uncovered interest rate parity to hold. Now recall from our earlier discussion, if we are predicting future spot rate based on forward points, then effectively we are assuming that uncovered interest rate parity holds. And for uncovered interest rate parity to hold, the speculators or the investors must be risk neutral. So the correct answer for question 3 is A. Then question 4, forecasting that Japanese yen to Australian dollar spot rate 1 year from now will equal 79.25 assumes what? Now, if we are assuming that over the next 1 year the spot rate will remain the same, then obviously we are not assuming that uncovered interest rate parity holds. So essentially in this situation uncovered interest rate parity does not hold. And if we are saying that interest rates on average are expected, or the exchange rate is expected to be the same, then just take this as a given. We are essentially saying that spot rates follow a random walk. Don't need to get into details on this, but just take this as a given for now. And then question number 5, if asset managers completely hedged the currency risk associated with a 1 year Japanese deposit using a forward rate contract, the 1 year all-in holding return in Australian dollar would be closest to what? Now again, this goes back to a core point. So say you are the Australian investor and you have invested in Japan or in a Japanese investment, and the idea is this: on the Japanese investment you are going to get a return of 1%, and since this relationship is completely hedged, that means that your Japanese yen is going to appreciate by 4%. So hedged scenario means that you have taken out a forward contract. With a forward contract you are basically going to get the differential in terms of currency return. You will get the differential between these two currencies. So since Japan has the lower rate, your Japanese investment will appreciate by 4%, and overall you will have a return of 5%. So the correct answer here is C. For questions 6 through 8, we need this data. So question 6 says, if covered interest rate parity holds, the all-in 1 year investment return to a Japanese investor whose currency exposure to pounds is fully hedged is closest to what? So again, now imagine you are a Japanese investor and you have invested in England. So your return in terms of pounds is going to be 3%. But if you are fully hedged, then you also need to worry about then actually you don't need to worry about exchange rate risk, because you already know upfront that from a exchange rate perspective, the GBP is going to lose value. Lose value by how much? The difference of these two numbers, which is 2.9%. So GBP pound is going to give you, so the UK investment will give you 3%, but from a currency perspective, you are going to lose the differential of these two, which is 2.90. So overall, your return will be 0.10%. So that means the correct answer for 6 is A. If uncovered interest rate parity holds, today's expected value for the Japanese yen, so Japanese yen to GBP currency pair 1 year from now would be closest to what? So essentially, when we say that uncovered interest rate parity holds, that would mean that the expected spot rate is the same as the forward rate. So you can use these numbers to calculate the forward rate. And finally, with question 8, if uncovered interest rate parity holds between today and 1 year from now, the expected movement in Japanese yen to US dollar is closest to what? Now again, you solve this problem. Keep in mind that when we say that uncovered interest rate parity holds, then you can simply use the basic relationship that we talked about with covered interest rate parity. So this relationship, forward rate is spot rate into 1 plus interest rate in price currency over 1 plus interest rate in base currency. When uncovered interest rate parity holds, then we essentially say that the expected spot rate is equal to the current spot rate into 1 plus interest rate in price currency over interest rate in base currency. So exact same formula. And as I have said several times, in all these calculations, you need to be very clear about the base currency and the price currency. Given the convention used in the curriculum, the base currency is always this currency that's in the denominator. So hopefully you have understood this material. Again, I cannot emphasize enough that you must do this example very carefully. Even if you didn't, if you have a lot of time, you can read all the text in the curriculum. But if you don't have time, just listen to this, listen to what I have told you, and make sure you spend time on example 4. We'll now talk about purchasing power parity, where the focus is on the relationship between inflation and exchange rates. My strategy here will be to give you the core points, the most important formulas, and then work with you on example number 5 in the curriculum. So with purchasing power parity, the first concept that you need to know is the law of one price. You have seen this at level 1, so let's just review this very quickly. According to the law of one price, identical goods should trade at the same price across countries when valued in terms of a common currency. In other words, if you have a somewhat identical item such as a Big Mac, according to the law of one price, a Big Mac should sell at the same price across the world. So that's what the law of one price says. Now, as I'm sure you already know, this does not hold in practice, but from a theoretical perspective, you need to know that this is what the law of one price says. Now, there are two flavors to purchasing power parity. One is called the absolute version of purchasing power parity, and the other is called the relative version of purchasing power parity. So, according to the absolute version, the equilibrium exchange rate between two countries is determined entirely by the ratio of their national price levels. So, in other words, the exchange rate expressed as, say, foreign currency to domestic currency should purely be given as the ratio of the price levels. So in this case, it would be the ratio of prices in the foreign currency divided by prices in the domestic currency. Now, note the following. I'm using the terminology of the curriculum. So, in this segment, the curriculum uses foreign currency and domestic currency, but essentially, you can also think of this as price currency divided by base currency. So, throughout this segment of the curriculum, the foreign currency is the price currency and the domestic currency is the base currency. So keep that in mind. Even in the earlier segment on uncovered interest rate parity, the same relationship was true, where the curriculum used the foreign currency as the price currency and domestic currency as the base. So the first formula that you have memorized is based on absolute version of purchasing power parity. The spot rate or the exchange rate is given by price in the foreign currency divided by price in the domestic currency. In other words, exchange rate is purely determined by the ratio of the price levels. A somewhat improved version of purchasing power parity is the relative version of purchasing power parity, which focuses on inflation differentials. So according to the relative version of purchasing power parity, the percentage change in exchange rate, again expressed as foreign divided by domestic currency, is approximately given by the inflation level in the foreign currency minus the inflation level in the domestic currency. So this is the second relationship you need to memorize. This is also called the ex-ante version of PPP. So I'll just write this down for you, ex-ante. Number 3, you need to understand what we mean by real exchange rate, and you need to memorize the formula for real exchange rate. Real exchange rate is depicted by the symbol Q. So again Q, and this is expressed as foreign divided by domestic. This is given by the nominal exchange rate multiplied by the price level. Let's say price level is denoted by CPI. So CPI in the domestic currency divided by CPI in the foreign currency. So this is the third relationship that you need to memorize in the context of purchasing power parity. Now, if you try to understand the details behind this, that is a good thing to do, but it can be time consuming. This is explained well in the curriculum. From an exam perspective, I would suggest that at least know these formulas and then we will apply them in the example. So that's what you need to be good at. Also take a look at Exhibit 3. Exhibit 3 makes a very simple and basic point, which is that the relationships we talk about here, especially the relative version of PPP, which talks about predicting exchange rate based on inflation rates. So this relationship holds in the long run, but not in the short run. And the long run can be quite a number of years. So when we look at 12 years or 24 years, that's the long run. If we just look at 1 year intervals, then this relationship does not seem to hold. So now let's talk about the Fisher effect and real interest rate parity. According to the Fisher effect, the interest rate or the nominal interest rate is equal to the real interest rate plus expected inflation. Now, if we take this relationship both for a foreign currency and a domestic currency, then we can simply rewrite this with subscripts. So the nominal interest rate in the foreign currency is equal to the real interest rate in the foreign currency plus expected inflation in the foreign currency. In the domestic currency, we have the same relationship, except we use the domestic rather than the foreign currency. So we have this relationship. Now, using some basic algebra, we can show from this, so we can simply derive the following. We can come up with RF minus RD, so the real interest rate differential, is equal to the nominal interest rate differential minus the inflation rate differential. This is actually the expected inflation rate. So basic algebra, if you need to see the intermediate steps, you can look at the curriculum. But now we have this relationship. Let's apply the concepts we have studied earlier. If uncovered interest rate parity holds, then we can say that the differential, the interest rate differential, is the same as the percentage change in spot rate. So this is the expected change in the spot rate. If relative PPP or ex ante PPP holds, then the change in, or the inflation differential, is also going to give us the expected change in spot rate. So what this means is that if both uncovered interest rate parity and relative purchasing power parity hold, then essentially we have the same number minus the same number. So this is 0, which means that the real interest rate differential between the foreign currency and the domestic currency is 0. In other words, the real interest rate is the same in both currencies. And this is known as the real interest rate parity condition. So the real interest rate parity condition is this, which effectively says that real interest rates are the same in both the foreign and the domestic currency. So if this holds, so if this is 0, we can then say something else. We can also then say that the inflation rate differential, the interest rate differential, is equal to the inflation differential. So let me just write this down explicitly. So the interest rate differential is given by this expression, and if this is 0, then effectively we have the interest rate differential being equal to the inflation rate differential, and this relationship is called the International Fisher effect. So let's apply what we have learnt by doing example 5. So what I want you to do is open up example 5 and actually try to solve this on your own. So you can pause this video. Alright, welcome back. What we are going to do now is just quickly go through example 5, but as I mentioned earlier, hopefully you have tried to do this on your own. So we have an Australian-based fixed income asset manager, and he is deciding whether to allocate money between Australia and Japan. So we have a bunch of information given. Australia's 1-year deposit rate. So Australia's deposit rate is 5%, and that's much higher than Japan's deposit rate, which is only 1%. The Australian dollar is estimated to be 10% overvalued relative to Japan. So the Australian dollar is 10% overvalued based on purchasing power parity. So that's our estimate. So let's look at question 1. All else equal, which of the following events would restore the Australian dollar to its PPP value. So this is fairly intuitive. If the Australian dollar is 10% overvalued based on PPP, then essentially the Australian dollar so for it to restore its equilibrium value needs to come down or depreciate by 10%. So if you look at option C, it says the Japanese yen to Australian dollar exchange rate declines by 10%. So the Japanese yen to Australian dollar. Here, Australian dollar is the base currency. If you recall from our earlier discussion, if this number goes down, this exchange rate goes down or declines, that means that the base currency is declining or losing value. So essentially this needs to go down by 10% for purchasing power parity to be restored. So fairly intuitive. Question number 2. If both Australian dollar and Japanese CPI price levels increase by 5%, then what happens to the real exchange rate? So now recall the formula for the real exchange rate. So the real exchange rate, Japanese yen divided by Australian dollar, is given by the spot rate, which again is Japanese yen over Australian dollar, into the CPI of the Australian dollar divided by CPI of Japanese yen. So this is one of the relationships I asked you to memorize on an earlier slide. If both the price levels are going up, then essentially the exchange rate will not change. So the change in real exchange rate is going to be 0% because we are told that both the CPIs are changing by the same amount. All else equal means that the nominal exchange rate is not changing. Question number 3. If real interest rates in Japan and Australia were equal, so this is essentially we are saying that the international Fisher effect holds. So if real interest rates are equal, then under the international Fisher effect, the inflation rate differential between Japan and Australia would be closest to what? So we are already told that the interest rate differential is 4%. So Australia 5%, Japan 1%. Interest rate differential is 4%. Now, given the international Fisher effect, the interest rate differential will be the same as the inflation rate differential. So the inflation rate differential is also 4%. According to the theory and empirical evidence regarding purchasing power parity, which of the following would not be true if PPP holds in the long run? So option A, an exchange rate's equilibrium path should be determined by the long-term trend in domestic relative to foreign price levels. This actually is a true statement. Deviations from PPP might occur over short and medium-term periods, but fundamental forces would eventually work to push exchange rates towards their long-term PPP path. So this is also a true statement, and the data in Exhibit 3 illustrates that fact. And finally, high inflation countries should tend to see their currencies appreciate over time. This is completely incorrect. In fact, high inflation countries actually, the currencies lose value. And finally, which of the following would best explain the failure of the absolute version of PPP to hold? And here, option A, inflation varies across countries. That's not the correct answer. B is not correct. So you actually need to memorize the fact, or it's rather obvious anyway, that the reason absolute PPP does not hold is that trade barriers exist and different product mixes are consumed across different countries. So the reason a Big Mac doesn't cost the same in Pakistan as it does in the US is that it's not easy to just transport Big Macs without any cost from Pakistan to America, and which will explain why the prices are different. So while absolute PPP is a nice concept, in the real world it does not exist for the reasons given in option C. I'd strongly encourage you to read section 3.1.6 from the curriculum, which ties together the various pieces we've been talking about. But let me just give you the core points. Covered interest rate parity. This essentially is the relationship which allows us to compute the forward rate based on interest rates. So as a quick recap, here is the formula. This is perhaps one of the most important relationships which you see here, and then you will see later in the curriculum. As always in these relationships, we express forward rates and spot rates in terms of a price currency divided by base currency. So this would be the interest rate in the price currency. This is the interest rate in the base currency adjusted for number of days. So that's covered interest rate parity, helps us determine forward rates from which we can determine the forward premium or the forward discount. Uncovered interest rate parity allows us to predict expected future spot rates based on interest rate differentials. So essentially this is similar to the covered interest rate parity, but the difference is that here we are coming up with expected future spot rates. If uncovered interest rate parity holds, then forward rates are considered unbiased indicators of future spot rates. So if I were to actually write the uncovered interest rate parity relationship, it would look like this. Expected future spot rate is equal to the current spot rate into 1 plus interest rate in the price currency over 1 plus interest rate in the base currency. Ex ante PPP, purchasing power parity, this essentially says that future spot rates can be predicted based on inflation rate differentials, and the international Fisher effect essentially says that the real interest rates are the same in both the foreign currency and the domestic currency, and what that then leads us to is the fact that the differential in inflation rates will equal the differential in interest rates. So these are the main relationships that we've talked about. Again, I would encourage you to read this section and then you must do example 6. Next, section 3.2, assessing an exchange rates equilibrium level. Here the curriculum talks about the IMF's three-pronged approach to determining long-run equilibrium exchange rates, and these essentially build on top of the parity relationships we've talked about. There is not too much detail on this. All you need to know is these three items and a brief description. So this item, macroeconomic balance approach, this essentially allows us to estimate how much exchange rates need to adjust in order to close the gap between medium-term expectations for a country's current account imbalance and the country's normal or sustainable current account imbalance. External sustainability approach. The way you can think of this is that a given country should have some benchmark level for its net foreign asset to GDP, and there should be some benchmark level for net foreign liabilities to GDP. And this approach essentially says that what must our exchange rate be in order for these ratios to stabilize at the benchmark level. Reduced form economic model seeks to estimate the equilibrium path that a currency should take on the basis of the trends in several key macroeconomic variables such as a country's net foreign assets position, its terms of trade, and its relative productivity. So essentially for this section you simply need to learn these three definitions and then do example 7. Let us now briefly go over section 3.3. I'll skip the long derivation in the curriculum and just help you focus on the formula. So in this formula, let's just understand this through an example. So say our foreign currency is the Indian rupee and our domestic currency is the US dollar. Then QFD refers to the real exchange rate. So the exchange rate with the Indian rupee as the price currency and the dollar as the domestic currency. Q bar refers to the long-term equilibrium exchange rate, and let's say that this is derived using purchasing power parity as a model. So let's say that we come up with a long-term real exchange rate of 10, and then we add the difference between the real interest rate in the domestic currency minus the real interest rate in the foreign currency. So let's say that the real interest rate in the US is 2%, and let's say that the real interest rate in India is 3%. So we have this number over here, and then minus we have the real interest rate. Actually, this is the risk premium on the domestic currency. So let's say that the US currency is very low risk. So for simplicity, the risk premium on the US dollar is 0, and the risk premium on the Indian rupee, let's say, is 2%. So typically a currency that is more volatile, and typically currencies in emerging markets will have a higher risk premium. So based on this, let's come up with the exchange rate. So it would be 10 plus, this is -1, minus -2, which is +2. So based on this simplistic calculation, the real exchange rate will be 11%. So just memorize this formula because it will come in handy later.